All right. Welcome, everybody. Good evening. I'm just doing a quick sound check, make sure that the sound quality is good, and make sure we can all hear this. All is good. I got an okay, a thumbs up. We're looking for sound is good. Okay, well, that's a good thing. Sound is good. All right, we're going to begin in approximately less than 2 minutes. A couple things that we're going to go over tonight. Um, Obviously, what we're headed for. Interesting times, and you know, we've got a couple people who we're hoping to see this, and I'm not sure if everyone can see the last chat someone posted here, um, which said, "Hi to all and Merry Christmas. Hope this is recorded as I have to sit with my grandson and won't be able to watch it live. Good luck to all." Well, that's funny about sitting with It's a nice event to sit with the grandchildren, that's for sure, and it's nice to have the ability to be with grandchildren. It's also nice that the grandchildren want to be with the grandparents, right? We have a lot to be thankful for in 2018, that's for sure. And I too enjoy the grandchildren because eventually they get older and then they don't want anything to do with us, right? Except for maybe favors. But I think this is a great time of the year as we enter into the holidays to spend time with family. I enjoy the time because as I know time is passing us by. So even for my own life, this is to sit back, we have to enjoy things, and we have to make sure the quality of our life is what we want and what we expect. And that's why we like to do these presentations. And the reason is that it helps me to be focused and also share some of the things that have helped me to get better and some of the things that I've gone through in my own life to do just that, get better. I think we need to focus. Uh, Sometimes you think of getting out of ourselves and what we do for a living, and it's stressful. And then, you deal with, and then all of a sudden you deal with family, and it brings back what we're here for. We're here to enrich and better others' lives. And in this case, whether it's you, our friends, or even our children or grandchildren for that matter, it's great that we can take this time that's coming upon us, the Christmas holiday, and share it and spend time with family. I always like to sit around at Christmas time, and what we've done in the past is to share a little bit of knowledge in the sense with we talk about what really is Christmas about. It's about the gifts that the three kings came to give Jesus. I mean, that was really what it was all about. And then it's morphed into this, mountain of toys, and the grandchildren love to rip through all that wrapping paper, right? Wow. So it's like a Thanksgiving meal. It takes like a day to prepare a Thanksgiving meal. It takes 15 minutes to eat it. Christmas is kind of like the same thing. We're preparing for this whole month, and then boom, it's over in a minute. And that's what the markets are kind of doing right now, right? I mean, we prepare and we do our plan, we develop strategies, and then boom, things change. And that's, we just have to learn to adapt. And that's what we're going to talk about tonight, tonight's presentation. How are we going to prepare for the new year in this particular environment? So I wanted to welcome everyone to the Person's Planet, probably the last presentation of the year to help you prepare for what we can at least try to prognosticate in this crazy market and go through a couple facts and some market analytics to help you navigate what seems to be a pretty wild market environment. So with that said, we have this wonderful risk disclosure statement that's suggesting that trading does involve risk of loss. Please take a moment to review that. And let's get right into it. We've got some fourth quarter trends that have been interesting. That generally speaking, these are some seasonalities that we see in the market. And I wanted to point out, if we take a look at some of these trends, like the broker dealers, the telecommunications sector, bonds, TLT, and utilities. And it's interesting to note, gang, right now, everyone's focusing on a couple sectors that have been what's considered to be defensive, and a reflection of I've heard people talking that because the markets are in such turmoil, bonds are a big buy, and utilities because it's a reflective of an investment that people want to go into during recessionary times. It's a defensive play. Well, the irony is that bonds tend to rally going into year's end, or at least in the fourth quarter, and that's what we're in right now, the fourth quarter. We're winding the fourth quarter down. And utilities, I don't know how many people have been hearing about utilities, and how it's a defensive play. Um, a lot of people. The more and more I hear about it, at least maybe I'm just hearing it from my circles of people talking about utilities being defensive. The funny thing is let's go and take a look at a couple charts as we go through in order to prognosticate where things might go, or look at the validity of what's being pushed out into the market right now. We're going to take a look at the XLU, and I'm going to go back, and let's go over here, and I'm going to change this style. This is using Thinkorswim right now. And I'm going to go back and let's go say 10 years and hit OK. So for the last 10 years, let's take a look at since 2009, the trend of utilities. It goes up into the end of the year. It goes up and then down a little bit, up. 1 year went down. 1 year didn't work, up into the end of the year. This year didn't do much. This year went down, up until the last quarter, let's say. Last year it went up, and now this year it goes up. Well, the funny thing is, if this is a defensive play, it's been a defensive play for the last 10 years because the trend has been higher. That's kind of like what I would want to point out. Does every year tend to peak out at the beginning of the year? And we can clearly see that. And I just wanted to go through some of these studies with you guys, and let me edit this study right here, and we're going to turn off our person's monthly pivots. Let me go over here to the wheel, and we're going to uncheck that. We're going to hit OK. We're going to hit apply, and we're going to hit OK. So now we're left with PPS, looking at the person's pivot study. Those are those buy and sell arrows. This is a weekly chart. In the middle, or the next quadrant down, this is our relative strength tool, the PMC indicator. And this tool is only found on Thinkorswim and my TradeStation lifetime package. This is a relative strength indicator that helps detect 4 stages of the market. 1, bright blue says that this particular instrument is outperforming the S&Ps. Dark blue means it's relative to the S&Ps, it's weakening. Red means it's lagging. And when you get into what might be hard to see, fuchsia color, the fuchsia color means it's starting to improve against the overall market. All right. Next is a on-balance volume indicator tool. And then down below, finally, I have Wells Wilder's average true range to help detect, or at least share, what the trading range environment is. I'm using a 20-period ATR, and you can see the settings right over here. So it's not like I'm trying to hide anything, but there's the Wells Wilder. It's a 20-day average true range. And as you can see here, we're at almost in the last, it's not almost, it's actually the highest next to 2009, the debacle way back then in 08. We're at one of the highest environments for a trading range on a week-to-week basis in the utility sector, which means this is it's become a historically high valuation in as far as trading ranges are concerned. So now the question begs, we normally see, and that's the whole point about tonight's presentation, gang, what tools are we using, and what are the trends? Where are we right now? And what are we going to be faced with as we come into 2019? Which, by the way, 2019 is about approximately what? 3 whole weeks away. So as far as trading hours, you think about open outcry trading session. I mean, I think we're close to maybe 90 open outcry hours. You can count them down. I think it's a little bit more than 90, but it's around there if you think about it. The whole year of our trading for this entire 2018 is coming down to 90 hours of open outcry session left. That's pretty amazing. Anyway, what I wanted to extend to you is we normally see the utility sector trend higher in the fourth quarter. And we just noted that the utilities have been trading higher since the bottom in 2009 on average every single year. So it doesn't look like the talk of being a defensive play has a lot of validity. That's the point that I want to make. Let's take a look at one other function here. We could do it on several different platforms, but since we're already using Thinkorswim right now, I'm going to go over here to, let me see if I've got this correct. Studies, no, style, excuse me. If you go to the very top of your chart selection and go to style, and just remember that, style, and you go down to chart mode, you'll see where it says right now we're in a standard chart mode. And the kind of chart that we're looking at is a candlestick. All right. If you go back up to chart mode, you'll see there are monkey bars expanded, and seasonality. For right now, I'm going to click on seasonality. And what you see on your charts right now is the actual trend of the price. This is utilities. And then down below is the seasonality of the marketplace. So let's expand this over, and the irony is that as we get into traditionally a seasonality of the marketplace, and we're going to change this over here to from daily to weekly. Here we go. We can kind of see where we start the year off, and it's as we can see from about December going into the end of January, utilities, they don't do so great. So the question now begs, and I just wanted to go over this, you can use this seasonality trend for any product you wish, and tonight's session is not to discuss and to go over how to utilize this tool. We have plenty of videos on our website that already describe how to use the Thinkorswim seasonality tool. And you're more than welcome to go through our instructional videos at personplanet.com. And they're free to use, and you can click through there to find out how to better utilize this tool. What I wanted to personally go through with you guys is just to say, listen, we're sitting here in a seasonality of a marketplace that traditionally tends to rise into the fourth quarter, and then it tends to kind of weaken. Now, is this year's rally, and you can see since about the beginning of June, the trend is sharply higher. The relative strength is obviously right now outperforming the market. It's bright blue. Volume on this trend is in question. And why do I say that? Well, technically speaking, we have a higher print high than we did at the last time the corresponding volume reading was up here. And you can clearly see price is currently making a new higher high on a lower volume reading. So quite frankly, and we are also seeing an expansion in the price ranges of the market at a near historic high, or at least can we say that the volatility or trading ranges is the highest it's been since, well, way back over here in 2009. That's a long time, gang. So what does it suggest to me? It suggests to me that perhaps if we get a turnaround in the market, and by a turnaround, I would be looking maybe in the next week or so, since the fourth quarter is still a seasonally strong period of time, I'd be looking for utilities to maybe weaken, and I'd look for sell signals. And for option traders, perhaps we would be looking for a turn signal on that PPS indicator like we got over here, and I'd be looking for volume to confirm that by the on balance volume indicator. So if we get as you can see, this might be hard to detect, but I'm trying to zoom it up for you guys. As the market starts to develop a sell signal and you get a corresponding lower reading and on balance volume, that would tell you that maybe perhaps we've got a rollover event, and the utilities are going to see more downside. So the one relative to the entire market, meaning the S&P market, utilities are still outperforming, but does that trend continue as we head into 2019? As we just shared with you from a seasonal perspective, no. But from a volume perspective, the market's not really supporting the volume action right now, is not supporting a much substantial move higher in utilities. So utilities right now, from a technical perspective, I wanted to go through and say, what is the condition of this market right now, not just based on the price, but based on some exclusive types of technical tools like relative strength and, again, volume trends. And then one other form is to look at this excessive high reading in its ATR. So that's kind of the things that I think would be important for us to watch for. I don't think I definitely, it's not that I don't think, I definitely draw the conclusion that anyone who says utilities are up because we're in a fear of a recession, I don't think that's necessarily the case. And so I'm dismissing that that jargon when I hear it in the media. First and foremost, let's take a look at the next one that I want to talk about here and look at some of these trends that we've seen: consumer staples, healthcare, industrials, and say, well, what have we been doing in the overall market this year, and where do we stand right now? So let's take a look at XLI. And again, these are fourth quarter trends. The industrials in the fourth quarter. When did the fourth quarter begin? Well, it started at the end of September. You got October, November, and now December. And quite frankly, since October, the trend is not up, it is down. So this year, the industrial trend, which generally goes up in the fourth quarter, has failed. Here's another little tidbit here. Another interesting aspect is look at the ATR. It's also expanding. So volatility is one thing that we're starting to see in the market, that on a lot of different sectors is we're seeing these wide price range swings, and that's detecting there could be a change. And so first and foremost, notice how the utility sector generally tends to rise this year. As we go back and look at the whole year, it's actually in a overall downtrend. The irony is that at this point in time, the relative strength is starting to improve, gang. And this last decline in the industrials, did it fall on a trending volume condition? No, actually, if you notice here, it has not. So this one goes up into the red flag, as I don't believe that it has a lot of more sustainability downside in the market. It just didn't adhere to this quarter's seasonality. Again, the seasonality for the quarter, let alone, it's been in a downtrend all year. Does that mean that going into 2019, it's going to continue? I think this would be one in the industrial sector that some things are starting, it looks as if it's starting to change, and I'd be watchful of the relative strength to improve, kind of like it did over here. If you notice here, the relative strength the bars started to make higher lows. So I would be watchful for improved relative strength in the marketplace, and that would tell me that maybe we could see a reversal in trend. This was, by the way, back in 2016. This goes back 2 years. So with the relative strength right now and the sell-off all year, there seems to be some conflicting evidence in the market, and this is what I'm sharing with you. If we're headed for a recession, the decline already began earlier this year. I mean, we peaked out in January. It barely made it up to testing that high one more time back in September, and then quickly fell off the shelf of support, let's say. So with utilities being at their yearly or maybe close to a historic high, with the industrials XLI sector being closer to their low, I think there's a chance that we're going to see a reversal trend in 2019. Utilities back down, industrials potentially back up. let's face it, this market has absolutely been a roller coaster ride. And I don't know if you can depend on just plain seasonalities because of one major event. We noticed that after today's price action, the market really didn't give a hoot about the Federal Reserve. This market is more about policies dictated or fiscal policies dictated by legislation. And so what that means is that we have Republicans in control of the White House, Republicans in control of the Senate, and Democrats in control of the House. If you watch today's interview between, and I don't want to get into too much on the political front, I want to just say, how is the market reacting to the political front? It's a talk that typically the market likes gridlock. And in this case, I don't think that's true this year. I think the gridlock is good when there's set policies in place. And I don't think there's enough solid policies set in place to see continued economic growth. That's when all of a sudden this market has seemed to start to unravel, noting that we have the Democrats are definitely not going to get along with the Republican for the next 2 years. That's what the market's really mostly nervous about. But, despite that, and despite today how the market reacted, the bottom line is this. Tomorrow morning, we're all going to wake up. On December 25th, the majority of people in the world will wake up to Christmas, and they'll be with family. There'll be a Christmas dinner, and, many people will be celebrating their rights to freedom of religion, going to church, etc. here in America. And around the world, we'll be celebrating this. And, the moral of the story is, eventually, maybe we put our differences from a political standpoint and things will still go by. So we'll still have the economic engine of where we're at right now from at least looking at employment. We still are not in a recession. The market may be overreacting. And I think what's interesting is that the technical analysis tools that I'm sharing with you and the guide of not just the fourth quarter trends, what I wanted to suggest to you, gang, is that it kind of shows a different tale of the tape right now. That's what's kind of interesting. Let's look at TLT right now. Typically, we see in the fourth quarter bond prices. We see bond prices typically in the fourth quarter rally. And quite frankly, since the beginning of October, here's the beginning of October, fourth quarter trend, price is up. So not only is price up, but look at the relative strength of PMC. It started to show that as the price, and this is an important observation, I want everyone to learn this pattern. This is called bullish convergence in markets that correspond or different indicators that have to do with correlation. Typically speaking, stocks and bonds do go into a tandem relationship of price, and many times they go through a decoupling. So you can't really say that they trend solidly tick for tick. Throw that out the window. But what we do see and what is interesting to note is as the prices have started or it went down into this October time period, the relative strength started to improve. And note that one other item has occurred. It went up in price with an accumulation of volume. So ironically speaking, we are actually looking at a product that has traditionally moved up in the fourth quarter. Bonds typically trend higher. That means TLT price. And so we did get that, unlike what a lot of people thought, because the Fed was raising rates and bond prices, when yields go up, price goes down. We have a kind of a commonality here. Bonds are up, utilities are up, industrials didn't quite work. Let's take a look at two more, and then we're going to move on into what we see happening, and because this is an important foundation for the next phase of tonight's presentation. Again, it goes in the line of, if you don't know where the markets have been, how can you ever figure out where the heck they might go? And when we take a look at consumer staples, they generally tend to trend higher in the fourth quarter. No offense, this did work out. Now, not all staples went up, but here's another meaningful observation. Note that the relative strength is all bright blue. This is the PMC indicator. This stands for the person market catcher. The relative strength has outperformed the overall market. Utilities go up normally. We see bond prices go up normally, and consumer staples actually go up in the fourth quarter. So what I find interesting is that when you hear people say, hey, these are all defensive markets that have gone up because the people are afraid of a recession, it's like, knock, knock, guess what? This normally happens anyway, in most years. The funny aspect is, has it really been an aggressive rally? And the answer is no. Here's the other observation. Is the market going up with very significant or strong volume trend? Using the on-balance volume indicator, and the answer there is no. But what is also interesting to note is this, and this is the commonality. Where in relationship to past price action and by measurement of trading ranges, where is the average true range of this product? It's at the highest level it's been since, again, 2009. This is consumer staples. So what is really changing in the market, in the landscape, is seasonality does prevail in many of these sectors. I thought you'd be interested in that finding, number one. And number two, we also have pretty much three sectors that we would normally not see heavy-duty volatility have excessive volatility, or at least extreme volatility, since 2009 by a measurement of the 20-period average true range. Now, what does that suggest to me? If staples tend to rise, which they did, if utilities tend to rise, which they did, and if they start to change their makeup in 2019, the seasonality starts to roll over. They're at this point vulnerable for price declines. So moving ahead, I don't buy the story personally, and I'm just using technical analysis to say, gee, is this the marketplace that is getting prepared for a market crash? In other words, is the market getting ready to see a 1929 crash, or is it already here, right? So looking at staples and utilities, these are the sectors that and bonds that typically do move up. Let's look at one last one, and we're going to go through XLV. And so XLV, in looking at the healthcare sector ETF, and if you notice from the approximately the beginning of October, it didn't really go up, but it's not really done anything. I guess you could argue that it's on average, give it take one whole week from October, it's break even. It is outperformed the market, and how do we know that? Because it's bright blue. So the healthcare sector has outperformed the overall market. It really hasn't gone down, it hasn't gone up, but this is traditionally, again, the strongest time of the year. One last item I want to point out about the commonality. Even healthcare, according to the ATR, now it's not at an extreme. We had a big move over here back in 2015, as you can see. But boy, one thing is, one of the commonalities of this ATR reading is, again, another segment sector ETF is at a high volatile, at least price change range indication, one of the highest readings. And look at the market condition here. It has outperformed the market, and the volume on this upside move is light. What's my takeaway here? My takeaway here is, in periods of high volatility, sometimes that does tend to mark tops and bottoms of the market. So I think what was strong as we conclude 2018 will maybe weaken as we begin 2019. So that's one of the observations that I wanted to leave you with. Now, as we begin 2019, and here's the key, this has been recorded. I wanted to go through a different look of the market using special market indicators meaning I wanted to look at the relative strength. I wanted to look at the seasonal trends. Are the markets, have they respected their past or current seasonal trends? In other words, let's take a look. Have the bonds respected their fourth quarter trends? Yes. How about utilities? Yes. How about industrials? Not really. Healthcare? Yeah, to a degree. How about staples? Yes. We'll do one more. Telecom, IYZ. Well, here's the telecom sector. Since October, the first week actually, it has gone down. It just hasn't gone up. It is outperforming the market relative to the S&P's decline. It's actually flatlined. So one of the irony here is one of the very few so far of all the products that we shared, look at the telecoms is one of the more muted trading ranges. So the question here begs is, does it have room to go up more? It's outperformed the market. It hasn't gone down. Volume action isn't really corresponding to a breakout, but as the market has gone down to sideways, so has the volume. So my reading here is when I look at telecom sector, the first kind of name that we're going to look at, looking kind of like under the hood, so to speak, gang, is to look at Verizon. Wow. So in the last quarter, telecoms go up. Verizon went up. What about TMUS, T-Mobile? T-Mobile went up. How about American Towers? American Tower, wow, it's gone up. Let's take a look at one more, Crown Castle International in that space. Wow, that stock has gone up, outperformed the market. And then lastly, let's look at AT&T. There's the culprit. One stock in the main sector has underperformed the market, kept the IYZ or the telecom sector ETF on the downside. And the funny thing is, even though AT&T hasn't rallied, it's still outperforming the market. It just doesn't have any volume in there. So my reading here, or my takeaway here is, while we have not seen a participation, a really negative correlation, it just, things haven't really been 100%. So I like to look at seasonality and look at a product and say, if seasonality, if it's been working in the past, my assumption is it will continue to work in the near future. So the ones that aren't working, which would be industrials, telecoms, they probably might not work moving forward. So we got to kind of take those off the table. That's what I wanted to point out. How do I look and evaluate a sector and a product using seasonality? If we know we're coming into the end of the year, we know that we're going to have a lot of different changes in seasonality. What are those changes? Well, taxation issues creates seasonality. Typically, when you have a stock that's in a losing position, you'll liquidate it towards the end of the year and take that tax loss credit. And stocks that are up on the year, you tend not to dump any of those, so they tend to remain stronger through the end of the year. So we're going to have a list of stocks at the end of this week, and you could probably take a gander, and we're going to use, for this, I'm going to use a different platform, one of my favorite platforms, which is, of course, Trade Navigator, Genesis, and it has all kinds. It's not through a broker, it's just an analytical platform. And what I want to do quickly here is look at all the stocks that are at or near 52-week lows in the S&P 500. So typically, a stock that's near its 52-week lows, they tend to stay down into the end of the year. So those are the ones that we want to kind of start watching for, maybe reversals off of these lows as we get into 2019. Now, how do we qualify them a little bit better? Well, we would look for stocks at 52-week lows that are in sectors that are entering a period of seasonal strength. That makes sense, right? So if we have a stock that maybe you want to be looking in the retail section, retail electronics, Best Buy. Maybe you weren't aware of it, but Best Buy is approaching its 52-week low. Ironically, look at the seasonality of Best Buy. At the end of the year, it has a tendency to rise. So we'll be watchful of best buy in the next couple weeks. I don't suspect it's going to see any amazing rally between now and the end of the year, because this is a stock that would be more than likely under selling pressure. You know, another one that's pretty famous for being at a 52-week low, let alone a 10-year low, is GE. And GE is also under that umbrella kind of concept where by the end of the year, people, if it has no rally attempts at all, it more than likely has the ability to rally from its seasonal perspective into the end of the year, going into, are you going to like this, the first half of all of next year. So generally speaking, you have a seasonal tendency for GE to rise. So this would be another one that we would be wanting to focus in on, stocks that may be seeing reversals. So tonight, what I wanted to really get into was how are we making a shopping list into 2019? Stocks that are nearing 52-week lows that enter a seasonally strong period of time. That's number one. And I also wanted to be looking and be watchful of sectors and stocks that are at 52-week highs, that are rallying on depreciating volume. That would give us a kind of that bearish divergence pattern. By the way, bearish divergence pattern. Let's take a look at a couple really famous ones that we saw this year. Many of you, and I know for a fact, many of you have attended our past seminar, webinar classes that we gave. And so let's go down memory lane. One was our more famous topping pattern that we had called out for Amazon. By the way, look at Amazon and look at the person market catcher. As it started to make newer highs on the year, the PMC, or relative strength indicator, was making newer lows. In fact, we finally pointed out a weekly PPS indicator and a major engulfing pattern. Now, let's go and take a look at that on a daily chart, just to be fair. A double top pattern. Look when the double top pattern occurred, from peak number 1 to peak number 2, followed by my more famous low close doji, which we did a nice trade on that on the short side on Amazon, mainly because we noted that the longer term, higher degree time frame weekly analysis was showing relative strength divergence. It was weakening against the overall market. The market went back up to test the high on what? Lower volume. This was a bearish divergence pattern, one of our more watchful ones. Let's take a look at another one that was pretty famous this year. Facebook. Noted that it was rising ahead of its earnings. Look at the corresponding highs. Look at the relative strength. It was a leading indicator that was warning traders, the higher this thing goes, it is not showing relative outperformance. It was susceptible for downside action. Now, since I'm on the subject of Facebook, and since we already have this teed up, the opposite is kind of true in Facebook down here, in the sense that look at the relative strength right now. It has formed a kind of a convergence pattern. Price has made what? Newer lows. And we're starting to see, relative to the other markets like Apple and some of the other technology names in social media, we're starting to see the relative strength not just improve, which is pink, but it's outperforming relative to the overall market right now. And look at the volume trend, gang. This is an impressive chart that shows that Facebook is actually seeing a little renewed interest in buyers down here, or at least it has been, between the price between 136 and this now 142 handle. There's been buyers coming into the market since approximately that 136 number. So pullbacks will be defended, and if the relative strength continues to show outperformance or being blue, and as long as the volumes continues to show accumulation, Facebook at this 136 will be supported between now and possibly the end of the year. So I just wanted to go through that little bit of analysis in, again, A, showing you bearish divergences, B, how it works with specific indicators like the person market catcher, and as well as how we utilize that in conjunction with volume analysis, particularly on balance volume, which is one of my favorite volume tools. So moving forward, folks, in the first quarter, crude oil tends to move higher in the first quarter. Now, the first quarter includes January, February, March. And actually, to be fair, the best time of the year to buy oil and oil services and refiners, by the way, is, and we take a look at OIH, let's go there for right now, worst performing sector on the market by far. OIH, by the way, year to date is the worst performing sector on the board, oil services. The irony is that this sector starts to turn its seasonality around going into what? First quarter. So we just discussed about seasonality, and more importantly, maybe this information will help you to time a entry in a market a little bit better. From beginning of the year 2018, oil service sector, it's down. So if anyone's long this sector between now and the end of the year, tick tock, the clock is ticking. The clock is ticking down. If you're long this sector, you're running out of daylight savings time to sell out to take this as a tax loss credit. So this is going to be one of the sectors that would probably be this year's dud, is going to be next year's darling. So oil service sector is one that I am going to be looking for and watchful for. And again, let me change this. It starts with a daily chart, and you can clearly see it right now. The relative strength is starting to do what? Price has gone lower since the November lows. The December lows are lower. Do you agree with that statement? We currently had a low on November 13th at 1867. We're at 1625, but the relative strength reading has a higher low. What I'm going to be watchful for over the next week and a half, as we get through option expiration, as we get into the end of, the end of this week and into the middle of next week, I'll be watchful for this space to consolidate, and I'll be watchful for some upside movement, because going into 2019, one of the best times of the year to buy the energy space is actually in the early mid-January to early February time period. So I'm looking for this. We're starting to already see signs that we're coming into some testifiable evidence that the oil service sector, relative to the overall market, is, even though price is down, it's starting to improve. It's falling less in terms of its relative decline to the S&P 500. So I'd like to see a little bit more evidence of a turnaround. I'm not saying to go out and buy it tomorrow, but even on a 60-minute chart, there's no real strong volume. No one's really in this right now. So we're probably, in terms of open outcry trading hours, if there's 6.5 hours per day, maybe we're within 25 trading hours. Think of it in that terms, 25 trading hours for maybe a potential buy, and I'll be watchful for OIH service sector for some buy setups using these particular forms of market analysis. So that's one of the things that I wanted to get into. Retail, a lot of people think because of Black Friday and the holiday, retail tends to trend higher in the fourth quarter. Not true. It's actually after earnings season comes about, and that's mid-January into February. Home builders, we're talking about interest rates, and a lot of people are looking at home builders. And for that, I'm going to turn to my good friend, my trade station, ITB, and we're going to look at home builders here. The home builder sector, to be honest with you, looks like it's got a lot more downs, in my humble opinion. The long-term monthly analysis, this is a monthly chart using the person's indicator package. In order to figure out where a market might go, you got to ask yourself, well, where has it been? And quite frankly, if this is, we're entering a segment of the market, this is also going to be not only under perhaps some tax loss credit selling pressure between now and the end of the year, but quite frankly, Q1, first quarter, it's not a very good time of the year for the market either. So this is trading around 30.56. I could easily see this down around, at least another, if you would believe it or not, 15 to 20% lower. I mean, if you go 20% is $6, that would be $24. So 15%, somewhere between 25. Look at 25 represents on this chart, gang. Old highs, old lows, average of prices from 2016. Could you conceivably say that the market, I mean, obviously it to me looks pretty evident that the path of least resistance is down, and if the first quarter is weak, could we see a market at least get into perhaps that line in the sand? And the answer is sure. Volume using on balance volume is already crossed over. This is a proprietary volume tool, and it's about as ugly gets. And so to me, I think that the home builder sector, actually don't be surprised to see lower prices. Technology in the Qs, we tend to see lower prices in Q1. And then finally, the utilities. I did put this out because I wanted to share with you what was strong tends to weaken, and the headline news isn't always the best news to believe. If people are putting out there to buy utilities because it's defensive against the recession, you know what? I'm not buying that story. So watch out for a reversal in utilities as we head into Q1. And I think these, if you look at what the seasonality is, and then say, hey, let's do a little bit better analysis. In other words, let's be more thorough and detailed in our work. You can't just say, hey, seasonality is great and it works every year, because it's not, and it doesn't. It doesn't. You need to utilize it with other tools. And that's one of the things that I wanted to kind of point out. A lot of things have changed in this last 10 years. And we've been looking at seasonality. We've been looking at ATRs, at extremes that we haven't seen since 2009. That's now going almost on a decade. What has changed? What we've traded, look where we've gone in 1 year with Bitcoin, for gosh sakes, right? Last year, a year ago at this time, Bitcoin was close to what, $19,000 a contract, right? Let's take a look at Bitcoin real fast. You guys remember Bitcoin? Well, we just had the futures out. Let me go and use this one right here. There we go, Bitcoin. So let's go over, and we're going to go, if you guys, I mean, 20,000 was the Bitcoin, and we're at 3,300. This is the Bitcoin futures contract at the CME. Either way you look at it, a lot of things have changed in 1 year, mainly the valuation of Bitcoin. That's, kind of interesting. Pot stocks, marijuana. I mean, just the fact that I can say pot stocks is crazy, right? I mean, you think about high school, at least for me, in the 70s. I mean, people getting busted. Jerry Garcia from the Grateful Dead, if he was still alive, if he could only see now that he could legally smoke pot, let alone Jimi Hendrix and Janis Joplin. Wow, talk about things have changed in our world. A lot of things have changed. And I think that in this change, some of the tools that I'm using in my analysis, seasonality, we still like to look at that. We like to look at relative strength, and we'd like to look at volume, but I think we need to make some of these technical tools, just adjust them to, update them to, current times, make tweaks and adjustments to indicators to help us maybe prognosticate the markets. And better yet, take a look at, in other words, to figure out where something might go, figure out where it's been. yesterday's products might not be around for next year. And, on that note, how many guys do you remember? It's kind of ironic. And I just want to bring this up. Talk about last year's dogs, this year's gem. Do you remember that? Oh, this is a great little story. Do you remember in last year in 2017, Amazon was going to put all the brick and mortars out of business. Macy's was at $17. This is a great little story. I'm going to share it with you. Just to give you an idea about different indicators. Okay, let's compare apples to kind of apples. So this is your trend in Macy's. This is, again, your on-balance volume. I'm going to bring this into perspective here. And this is my little volume indicator. I wonder if you guys can see as we point out from this low to that low. And if you notice that in 2018, we started to see kind of a gradual increase, but the relative strength started to improve. The volume action made a newer low. But if you look over here, this is a volume tool that measures volume in terms of percentage. That's a great example of modernizing different technical tools. The funny thing is, everyone was focused on the brick and mortar stores to go down to zero. In fact, it's kind of the opposite. Last year's zero is today's hero. And I think you're going to find that theme will resonate with a lot of the stuff, especially the stocks that are at 52-week lows. What I would like you to learn and focus in on is how to develop a sense of analytical skills to uncover bullish convergences and better use the relative strength tool, because if a stock is making a new low, if it's making a new low, is it making a new low with improved relative strength? Is it starting to go up on improved volume? If that's the case, it gives you a better edge in understanding and having a better sense or not a better sense, but it gives you a better edge in the marketplace. So there's a lot of things that have changed. We have volatility products like the VXX. We're missing a volatility product this year. We won't talk about that tonight. But we also have, as I mentioned, cryptocurrencies, pot stocks. There's so many things to trade. There was a time where we saw foreign currencies as the big, incredible market trade opportunity. And what do we have now going on? Let's take just a quick look-see of what is happening. In the currency world, we have the British pound. By the way, if you're going to England for the holidays, this would be one of the years you absolutely want to go, because the British pound is close to a level not seen since 2016. And the last time we were there was in 2002. So this is actually one of the least expensive time to go visit England, thanks in part to confidence, GDP, and this thing called Brexit. Brexit, tomato. So what is our prognostication here for the British pound? Well, ironically, let's take a quick look-see on a monthly chart and just examine something closely. We have old lows in the market. We have an on-balance volume reading that has made a newer low. We have the current price that has not made a newer low. And this little volume indicator is suggesting a slight convergence pattern. So what that means is we're more than likely, if we get down to maybe 124, to form a potential double bottom. So somewhere down in here, I'm expecting in Q1 a rise in the British pound. This is something that I think that we'll see, believe it or not, relative to the US dollar. We're going to see the British pound improve in its price appreciation over the near term. Let's take a look at one other metrics that we like to measure, and it's called the Commitment of Traders Report. Now, I've shown you several different indicators that are exclusive use to different markets, such as relative strength to sectors and stocks to the overall market. This one is the Commitment of Traders Report, which shows whose hand the market is in control of. And the irony is, and let me go over here, you'll better see this. This is an interesting chart pattern here real quick. We're going to go over to color, style, and I'm going to go to a line over here. Speculators, a line there. Okay, great. Here's an interesting component. There are three colors, and what this indicator represents, red are the commercials, and they're long. Blue are the hedge funds, and they are less long. Yellow is the small speculators, the one-lot traders, the small speculators, the people that are just in the market because they think they know everything. The funny thing is they have one of the largest net short positions. The last time they had a net short position to this magnitude, look when it was. I'm just going to go on down. I'm not going to make this a little prettier. I'm just showing you was at an important low in the market. These small speculators, the commercials started to get out of their hedges. The hedge funds started to get out of their longs, and the small speculators got caught with their pants. They got caught on the short side of the market. So right now we have hedge funds reducing their short exposure, commercials reducing their hedges, and small speculators increase their short position. This is also a sign in the near term that we're more than likely going to see the British pound recover in the next few weeks. So I would be looking for a recovery based on a longer term analysis, looking at the monthly charts, and B, a unique study by examining not just the volume action, look at the trend of the market. It's moving down while the volume is not moving down with price. That is a divergence pattern, and the only ones that are aggressively shorting the market or continuously selling the market are the speculators. So this market, while they're winning right now, this market is susceptible for a rally as we head into the year end. So you want to kind of be watchful of that. So tonight's presentation, I wanted to just go through what has changed, where we have changed, but not all of the indicators we use have changed. I'm still teaching and still utilizing some of the same indicators that I've been teaching for decades now, and have written about in several very popular books, namely Candlestick and Pivot Point Trading Triggers. Isn't that wild? This has been my person's trading methodology. A couple things that we didn't really talk about tonight was money management, last additional changes, but we did talk about seasonal analysis. We did talk about volume. We talked about commitment to traders report. I didn't get quite into breadth analysis, but we did talk about this right here, relative strength. So a lot of information that you'll see in my 12-step methodology, we still look at and covered in tonight's little end-of-year get-together. I still think a few things that we want to maybe point out to you guys. Price indicators are still important, but notice that tonight I looked at not just volume analysis, but I looked at conditional analysis. I looked at the consensus report with the COT. Now, while I didn't go into advanced decline, I didn't look at the open interest. I looked at another rate or another metrics, ATR, and we noticed that the average true range was at the highest end of any segment of the markets of what's supposed to be safe and secure products like utilities, at the highest ATR since 2009. So a lot has changed, but what we utilize as far as technical tools does not need to be changed. That relative strength tool that I was talking about with the PMC, study that over this year, because boy, I'm going to tell you something, gang. When you get one of our patterns that we talked about in our live 3-day seminar a couple weeks ago, and I think a few of you were actually there, right? Who was at this seminar that we had here? Do we have any repeat offenders? George, you were there. Absolutely. Thank you. Malcolm, I know you were there for sure. This chart, I said, this you want to be you want to have a go-to pattern. If you're going to have a pattern, you're going to want to see buy signals, breakouts. You're going to have the momentum indicator. You're going to want to see your relative strength improve, and that's your go-to setup. If you're looking for buy signals and if you're looking for breakouts, you want to make sure that whatever you're going to get into, it looks like this. You have momentum and you have your relative strength and you have volume as a confirmation. Now, these are tools that many of you have never seen before, but again, relative strength, volume, it's not, again, actual volume. This is percent change of volume in that momentum histogram tool. That's what makes this unique. This is the relative strength PMC indicator, and this is a momentum indicator found on our TradeStation package. Many of you already know what this is. It's the PMC, and you know these are person's pivots. So again, part of your game plan is if you're going to use seasonality and you're going to see market segments change, use the indicators to give you confirmation and at the very least, a couple things. The relative strength improving is a warning sign that things are getting and going to get better. With volume confirmation, it shows that there's participation, and it's up to you to be able to capture that trend. By the way, here's a little, this is you'll remember this stock. This is from a year ago. It's Restoration Hardware. The relative strength, this stock, everyone thought they were going out of business. But here is a beautiful little PPS buy signal. This is a weekly chart, gang. And here is the improvement of the relative strength. So when this comes out on video and you want to do something, screen capture this, put that on your desk. This is one of the things in an exercise we told our clients to do. And make that your pattern, and if you're going to get it long a market, it has similar characteristics where the stock outperforms relative to the market. It has improved relative strength. So use confirmation. I thank you for joining, and as part of our care for our clients, and also in the holiday spirit, we've got a series of emails. You ought to read these. They're awesome. They're fun-filled facts like, what are the name of the 3 wise men? What were the gifts they carried? The 12 days of Christmas. Did you hear about PNC Financial? There is a indicator based on the 12-day of Christmas song. Also, it uses that in reflection of how strong or weak the economy is. In 2018, things are looking pretty good, by the way. And you'll see those in emails that we're sending over the next 12 days with a fun-filled fact about not just Christmas, but the 12 days of Christmas, and as well some of our specials. And this is one that you will find on our website. And I thank everyone, if you do go to the website, and I'm gonna share this link with you right now, if I could. Let me get it in there. And I'll push that out there for you. And it's personsplanet.com and Control-C. If you're interested and you don't have any of our courses before, take advantage. We have some really excellent offers right now. And I think that for the Christmas holiday, you're going to enjoy this. It's Persons Planet. And again, it's /trading. And we'll put that right there, Control-V. It's personsplanet.com /trading.html. Or just, of course, you can go visit our website or send us and check your emails for these offers. But we have courses this week from $99 to $245, which are huge special discounts. Obviously, some of them are over half off. But with that said, I want to wish everyone, this is our last webinar for the year. I wanted to get you prepared in for the mode. This is going to be a very politically driven market. I don't think a lot of the headline news there's talks about all this headline news and headline stories that are used to generate phishing or algorithm programs that, when they see, so much XYZ on the news, they initiate selling or buying. And you know what? That's what's going on. And for the most part, that volatility is probably here as we get into, more so than not, the rest of the year, and as we just think about what we're dealing with the rest of this year, the new Congress, and then earnings season. Oh my. So this is going to be quite an interesting environment in which to trade. And again, a lot of our tools and techniques that we've been teaching for years are very efficient in this market environment. What I think traders need to do is, for example, be a little bit more short term in their holding periods. And of course, with ATRs the way they are, if perhaps you're not accustomed to this type of price swing in the market in the ES, by the way, by looking at the average true range in the marketplace, we'll go through this real quick. In the ES, we're back to almost 61 points average on a 10-day period for the E-mini S&Ps. ATR is right here, 60 points. That's about averaging a 15-minute bar. I think we did this I did this the other day. 15-minute individual 15-minute bars are about 13 S&P points. So if you have a trading system, a trading model that used to take maybe 3-point risks on a 15-minute bar, you can't take that kind of trade system. So a lot of people's trade systems are not working well because they're not experiencing this type of volatility. And that's, by the way, exactly why I wanted to express to you, look at the utility sector. One of the calmest, no one ever used to look at utilities as a day trading vehicle. But by the way, let's take a gander of something real quick here together, and we'll wrap this up. I'm going to look at alphabetically. So we're going to go down to XLU. And here's XLU. And just showing you my TradeStation package, you'll see here XLU. The average true range on XLU is 88 cents a day. 88 cents a day. That is kind of, today we only had a 65-cent move, but that, my friends, is a pretty enormous average true range for a sector like utility. So again, we are seeing enormous changes in price swings in the marketplace, and I think that's one of the things that's scaring traders away, because they have a less efficient way of managing their risk when prices are flying all over the place. So that's another consideration, and something we'll be writing about in our weekly research pages and our advisory service. So watch ATR. It's a rate of measurement that's very important to helping define trade systems and managing risks. And it is covered in some of our trading courses as well. So with that said, I hope you enjoyed tonight's presentation, guys. If you want to figure out where a market might go, ask yourself, where's it been and under what condition? With that, I bid everyone peace, happy holidays, and I'll see everyone back in 2019. Amazing. Thank you, everyone.